tired of all the uneducated noise you're getting from the droves of YOLO meme coin peddling douchebag gurus out there trying to use you as their exit liquidity? Would you rather learn a competent university-level set of skills that will guide you in managing and investing for the rest of your life? Join us 3 days a week at Digital Investor. Develop your knowledge of game theory, cognitive bias, macroeconomics, monetary theory, investment theory, psychology of the crowds, and more. For more info on Digital Investor and how it can help you, reach out at nickblacknext.com.
Hello. All right. Ahoy. I haven't heard ahoy in a while. Why does that make me think of chocolate chip cookies? Is that like a thing with chocolate chip cookies? Ahoy. It is, isn't it? Isn't there kind of like, that's a chocolate chip cookie thing. Anyway. Yeah. Hello. Okay. Let me see. Let me make sure all my buttons are correct. Is that right? All right. Chips Ahoy. That's right. Oh, yeah. Those are those little ones that break your teeth. Yeah, those are good. I like the hell out of those little cookies. Yeah, well played. I should have known Howard would know. Of course Howard knows. Chips Ahoy. All right. Before hello, it was ahoy. Look it up. Oh, that's funny. Okay. So a bunch of little disparate bits of news. We're going to talk about all sorts of stuff today. We're going to talk about, well, if we get to it. Hopefully we'll get to it. We will talk about the capital stack because I had some people getting confused when we were mentioning that. They were like, wait a minute, I don't quite. I was like, okay, cool. So we'll get through the capital stack. And then why it keeps coming up, I think some people were talking about pension funds and how many of them are having a really hard time. So taking huge risks. And they're buying not AAA debt, which won't mean anything if you don't understand the capital stack. But if you do, or you have some awareness of it, then you'll go, oh, pension funds are supposed to be where my money is safe. If they're taking risks like that, that's not safe. How are they going to be able to pay grandma her currency units back that they owe her? Well, I don't know. So there's some banks that are having some trouble. And I'm not going to talk about the specific banks, but we might go into the nature of how pension funds run and how then it's common sense when they take that kind of risk. You say, oh, well, they're going to blow up. Yep. So a lot of those are going to blow up, especially those that are taking exposure, pristine exposure to corporate debt that's like towards the junkier tiers. You know, the non-AAA stuff, but the AA all the way down to like the C-rated stuff just to get their yield up. And then you'd say, well, how come they can't make their yield? What's the problem? Why can't they make their 7.5% that they need in order to cover their annuities and lump sum payments? Well, because the Fed and some other central banks, but mostly the Fed, has artificially weirded out the short end of the yield curve, and then the curve is flat or sloping downward. It's inverted. So people can't banks that would usually borrow on the short end of a yield curve and borrow short, lend long, wash, rinse, and repeat, make their money for their investors, whatever. You can't do that when the further maturities are lower than the current maturity due to Fed stupidness. I mean, it's just the most boneheaded shit you can imagine. So, and the Fed will blame, they'll blame Oxycontin, they'll blame lazy Americans. Katie, what? You don't like pension funds either? Or you don't like the Fed? It's the Fed? You don't like the Fed? Come here. Come here, you. She doesn't like the Fed. Do you like the Fed? You don't like the Fed. They're a bunch of old washed up idiots, aren't they? Yes, they are. Okay, you can go. Boy, she just got riled up when I said Fed. Keep that quiet. Anyway, so we'll talk, but if you understand the capital stack and then you understand how pension funds work, then it just becomes more obvious how stupid all of these weirdnesses are, this monetary tools really are. And then I thought we would switch gears and talk about inference computing, which I think is where the future looks like it's going. Inference-based computing. So that's pretty interesting. We may not get to all this stuff. We'll try to knock out some of your questions along the path. And then the other thing was ASI. If you guys had ASI questions, like, you don't really have to do much of anything, but they did put out a document that explained a lot of stuff. And we could go through that. I think let me see. Somewhere, summarize about conversation. Let me see. Yeah. I think this is that. Frequently asked questions about ASI. So if you have ASI related questions, we could sort that stuff out. Anyway, there you go. Okay, so let me cruise down, say hello. Let me get underneath Chips Ahoy. And I think that's where we went. Okay. No, those cookies are good. If you smash them up into vanilla ice cream, it's awesome. It's like drinking the blood right out of the neck of the baby Jesus. Yes, delicious. Loki's good. He's big. He pees wherever he wants. He craps wherever he wants, but everything else is great. He's very nice. For a wild cat, he's very nice. He's wild. He basically, he'll do what he wants. And then you look at him like, what are you doing? He's like, what do you mean? What am I doing? I do what I want. I'm a wild cat. I'm like, yeah. Yep. All right. Chips. Yeah. In the blue package. Those are the ones with the regular ones. None of this sugar-free, saccharin-based chocolate chips. None of that crap. No. PJ, what up? Yeah. Okay. What? She's being very fluffy today. I guess that Fed talk got her wound up. Okay. What about when the ratings firms give AAA ratings? Well, that's crap. And it wasn't that they gave AAA ratings to these very risky assets. It's that they gave AAA ratings before they realized how risky those assets were. The CDO market and all that stuff. It was this attempt by banks to financialize everything, to take every single thing, take the staplers on your desk, the candles, wire, like paper clip boxes, every possible thing that they could take and turn into and financialize and turn into a financial product. They did. And what happened is they didn't re-rate things. So it's not so much that they rated stuff that was bad, good. Everybody was rating everything good because it hadn't crashed. But then when things started to crash, and these loan tranches were starting to get nuked because various parts of those baskets of assets were going into stages of default, they didn't re-rate them. And They didn't hey, don't buy that. That's a wire. They didn't re-rate things even after they were seeing them crash. They weren't re-rating them. And so that gets into a whole discussion of how the ratings agencies actually work and who pays for them and who funds them and their research and all that kind of stuff. Kitty, you got to make a decision, buddy. Nope. No, that's not the decision. Here, you go on this side. You go on this side. Got to get her away from the wires. She loves her some wires. Oh, man, messing everything up. Kitty, what? She's purring. Apparently, the way cats purr, that frequency, that's super healthy. It like helps them fight, bacteria and virus and all sorts of other stuff. So you got to get your cats purring at least a couple times a day for their health. All right. So it was a failure of re-rating. It was a lack of re-rating, and that was directly because they were getting paid by the agencies they were rating. That seems a little sketchy. And it is. And nobody ever goes to jail, ever. Let's see. It's overwhelming. Yeah. All of this stuff is overwhelming, and part of the overwhelming is how stupid people are, because you're like, well, how would competent people let us get into situations like this? I mean, God, it's bad. Global debt all boiled down, 400 trillion. Blech. A trillion here, a trillion there. Pretty soon you're talking about real money, right? All right, let me go to this one. Okay. Goldman Sachs exerted pressure on the ratings agencies to give AAA ratings to high-risk subprime bundles. Yeah, nothing changes. And, look, they were the same. Goldman Sachs and all these facilities, they're the ones paying these rating agencies. That's the problem. That's sketchy. You'd have thought that these rating agencies were, like federal agencies, like agencies of the government that are beyond that, but not so much. Let me see. Let me see if we knocked out most of the basic questions. Did you guys have any ASI type questions? If you do, we can briefly go through that. I have a little bulleted list that we could attack. Other than that, basically, you guys know what to do. Don't do anything. Essentially, let me get through the first part of it. This is what would concern you. For those of you, if you have Ocean or AGIX tokens, and you're saying, well, how in the hell am I going to convert those to Fetch/ASI? Because Fetch will eventually just rebrand to ASI. So if you hold Ocean tokens on an exchange like Binance or whatever, you don't need to do anything. Funds will automatically be converted to Fetch on the 1st of July. So if you have Ocean, it turns into Fetch. If you have AGIX, it turns into Fetch. Does that make sense? On the 1st of July. So if you're on an exchange, don't do anything. Okay? Great. All right, let's move to the next point. We'll just get through all these points, and then everybody will have it. The conversion from Ocean or AGIX to Fetch will be a temporary one, because about 15-ish days later, Fetch will then convert or rebrand to ASI. Okay, you won't, again, have to do anything. If you hold Fetch tokens on an exchange like Binance, you don't need to do anything either. Because the first phase won't really affect you, because the first phase of the token merger is where Ocean and AGIX tokens are temporarily merged into Fetch using those ratios, those totally bullcrap ratios that were published a while back that were done on a napkin by a bunch of idiots. But anyway, that's the ratio, and the ratio is the ratio. So by July 1st, if you have any of these three tokens on the exchange, guess what you have to do? Nothing. Now, I assume Coinbase as well. But the only token you would have on Coinbase would be, you would have Fetch, which again, do nothing, or you would have Ocean, do nothing. So either way, do nothing. Okay. if you self-custody Ocean or AGIX, okay, so let's just forget about Cosmos Station for a second. Let's just talk about you have them in like a MetaMask wallet or a Coinbase wallet, which is not Coinbase, by the way. It's just a product owned by Coinbase. So a Web3 wallet, great. You have Ocean or AGIX as an ERC20 token. Okay, on the Ethereum mainnet, that's what ERC20 means. You'll be able to convert your funds to ASI through the SDAO conversion portal. And I know most everybody in here just vomited up their lunch for the last 16 weeks because SDAO is not always the most consistent website. But that's where it's going to happen. So there you go. So pick out the big chunks, eat them up again because you need that protein, and off we go. So again, if you self-custody in a Web3 wallet, Ocean or AGIX, the Ethereum variety, there's going to be a portal at Singularity DAO, and the conversion portal it'll be open forever, basically for years. So at any time, you'll be able to convert those tokens over. If you self-custody Fetch, like on Cosmos Station or something like this, your funds will automatically be converted / rebranded to ASI once the network upgrade is complete. Now that would be, remember, when they say Fetch AI mainnet, that's kind of bullshit. There's no Fetch AI mainnet. What AI mainnet? It's runs on Cosmos, right? So if you have the Cosmos or native Fetch AI mainnet, get off the gas. Anyway, the Cosmos-based token, like in Cosmos Station or whatever, it will automatically convert to ASI once the network upgrade is complete. Okay, what is the timeline for these things? The merger will be implemented in 2 phases. First phase is July 1st, 2024. That is here in not so many days. A week and a little bit less. So the merger will be implemented in 2 phases starting July 1st, where the objective of the phase is to facilitate a smooth transition for exchange partners. Phase 2 focuses on self-custodied funds, Web3 wallets, things like that, and introduces the conversion tools that will remain open indefinitely. Okay, are there specific milestones or phases in the merger process? Phase 1, July 1st, 2024, here in a week. The project rebranding, token deposits, and withdrawals for AGIX and Ocean will halt. Fetch trading will continue. Great. AGIX and Ocean will be delisted from exchanges because they will be converting to Fetch. Does that make sense? So they're delisting those tokens because they don't need them. They will convert there. Now, I don't have a list of exchanges. I didn't see that yet. So we'll see. I wouldn't go, again, I wouldn't do anything. You don't need to do anything. If you own Ocean or AGIX on an exchange, it'll auto convert. If you own those in a private wallet, for now, don't do anything. Probably mid-July, so this is where phase 2 comes in. Mid-July, we'll call it the 15th. The deployment of the ASI token across chains, the Fetch AI network upgrade, the introduction of new migration contracts, and the opening of an EVM, an Ethereum virtual machine, and other bridges. They said that there may be potential network downtime and temporary disruptions on exchanges during the network upgrade in phase 2. So how will that affect tokens? There may be some arbitrage opportunities if this gets sloppy. The only reason I say that is because this team so far has not delivered technologically superior stuff in the past. And this is a lot of moving pieces, a lot of gears for, let's face it, a group that has been less than technologically sound in the past. And I'm not talking about Singularity Net. I'm talking about SDAO. They're the ones kind of handling this stuff. So I guess whatever happens, happens. Just assume there's going to be hiccups and there's going to be some slop. I'm not a fan of keeping my tokens on an exchange during something like this, just me personally, but I haven't had my tokens on exchanges in a long time. They've been in Web3 private wallets. So for me, it makes no difference. For most people, just don't do anything. You just don't do anything. Are there going to be some little hiccups and some thises and that's? Yes, probably. But there may be some arbitrage opportunities based on that. So, do with that as you may. Okay. Tokens, AGIX and Ocean tokens will merge into Fetch tokens, which will later rebrand to ASI. Does that make sense? So those are the steps. Tokens held on centralized exchanges will be automatically converted to Fetch, and then later that rebranding would occur. So assume on July 1st, they will auto convert to Fetch. You could stake that or not, and then it would rebrand to ASI. Remember, if you're staking it, then you have another issue. So there's two different kinds of Fetch. There's the Ethereum kind of Fetch, right? The placeholder Fetch. And then there's the native token, which is the Cosmos-based asset. Well, if you were on Coinbase, you have the Ethereum version of Fetch, the Ethereum version of Ocean. If you're on Kraken, you have the Cosmos version of Fetch, not Ethereum, the Cosmos, the native asset, which, by the way, you can send back and forth right between your Cosmos Station wallet. But you still have the Ethereum on Kraken. It's the Ethereum version of Ocean Protocol. So there's a bunch of exchanges expressing this is what they say, which, again, it may be propaganda. It said they've received a bunch of inquiries from numerous exchanges. So numerous. Expressing their support for the upcoming token merger. Never mind, no one's really talked about whether or not this is specifically legal, but whatever. While we appreciate the overwhelming interest, it's important to mention that we cannot guarantee participation from absolutely every exchange. The team is diligently working to facilitate widespread support, prioritizing a seamless transition for all token holders. Can you imagine Fetch and Ocean? Those tokens are on Coinbase, and then somebody from Coinbase gets a call from Mario, and he's trying to babble his way through an explanation of all. They're like, no, get one of the adults to call. Hey kid, get your dad to call. Get your dad to call Coinbase and explain what's going on. And then he's like putting his hand over the phone. He's like, hey, there's like some special needs kid on the phone talking about ASI or something. I don't know. Anyway. So price-wise, during the transition, if you have some period where the token's not traded, it could become, it does become extremely illiquid. That could be a little bit weird, maybe a little sloppy, may also be some opportunities in there. Also, though, don't get all bent out of shape if the price gets all wonky for a few days during this whole process. So there you go. Okay, let's see. What wallets will support the new token? It says major software wallets. Example, MetaMask, Trust Wallet. Hardware wallets like Ledger and Trezor. Additional clarity with respect to specific wallets will be given in as the merger proceeds. The ASI team is diligently working to ensure that as many credible wallet providers as possible are onboarded. Anybody with a Web3 wallet that has the Ethereum ecosystem, that kind of common sense. But anyway, whatever. All Ethereum compatible wallets such as MetaMask or Trust Wallet will be able to store that can store ERC20 funds such as Ocean, AGIX, and Fetch should be compatible. The ASI team is diligently working to ensure that these credible wallet providers are onboarded. Great. We aim to ensure that all hardware wallets that the community wants to use are actively supported. Yeah, of course, they want their token to be, that's all kind of basic stuff. Okay, staked. Those of you that have Fetch that staked. Okay. Staked fetch. Across the fetch AI in the Cosmos ecosystem. Quit saying fetch AI mainnet. That's all bullshit. In the Cosmos ecosystem will automatically be migrated, and staking rewards will continue uninterrupted. That's cool because it's just rebranding. It's just a name change. However, the addresses will change. All right. Tokens committed to long-term programs, such as those in the Ocean ecosystem, can be converted at a later stage, as the conversion portal will remain open for years and potentially indefinitely. Will there be any impact on staking rewards or benefits? Staking rewards and benefits in the native fetch, meaning the Cosmos station, the Cosmos ecosystem, will continue uninterrupted. What actions do you need to take if the tokens are in the liquidity pool or DeFi protocols? This is where you have to do stuff. If you're in a DeFi protocol or some liquidity pool, okay, you will manually withdraw and reallocate your funds to the updated pools. And that's going to be a little bit lengthier process. Okay. So there it is. And then there's just some more braggadocious BS about, ASI. Change the world. ASI. Got it. Okay, so that's the token merger. Yay. I think we pretty much covered it. I'll tell you what I would do. Oh, I think it may limit. I was going to say I could post this like little outline in the video. Maybe that'll work. Let me see. Okay, ASI token merger. I'm going to see if I can post this in the video. Let me see. I'll do this while we're live. You see if it's possible. I may be able to add it to today's video into the details or description. Let me see. In this basic lecture. Okay. Right below that, I can go here. Let's see. Okay, cool. So in the video on my YouTube, I just put a copy of that, the entire blueprint that we just talked about. I just put that whole thing in there. I just bulleted it. I ran it through GPT-4 and just cleaned it up because it was just a bunch of crap. Anyway, it's a lot cleaner now. So yay. Okay, we nailed it. Let's see. I believe the opportunity to benefit from the ASI pump is come and gone with all the hiccups. I don't think anyone cares. I think the goal with ASI is to scoop up a bunch of new people that don't know that these teams have failed in grand fashion. I mean, I don't think people care. People still buy Solana and the thing crashes all the time. They bought a lot. People don't care. This is the thing that I'm having to come to realize. Nobody cares. That your average investor now doesn't care that things crash all the time. They don't care that nothing works. They don't care that they're buying meme coins that have no value at all. It's mostly YOLO money. So I imagine they're going to go pump this to YOLO people. And a bunch of dummies, the same dummies buying meme coins, are going to buy the shit out of this one. Probably. Because if you're good at marketing, you don't need a real company. That's been proven time and time again. You don't need any kind of company if you're good at marketing. Theranos. Anybody? Theranos? Do you remember Nikola? The shitty knockoff of Tesla that filmed a video of a car rolling downhill. And at one point, their car company, again, no vehicle, their car company was worth more than Ford. Yes. Remember? Yeah, Theranos. Biology that didn't work. It wasn't even close. This is all bullshit. So no one cares. Listen, WeWork. Hey, let's take office buildings and put beer machines in them. Yeah. It's amazing. It's a new concept. Beer machines and coffee in an office environment. What the what? And everywhere else in the world, they're like, there's nothing new about this. What WeWork is doing isn't new. It's that Adam Newman is a weirdo and he seems to be able to get money. He destroyed that company. It wasn't even a real company, to be fair, but he destroyed that not real company walked away with billion, almost 2 billion. And then people are funding him hundreds of millions on his new stupid venture. Like, people don't care. If you dusted off Bernie Madoff, plugged him back into some kind of machine and turned him back on, people would give him money. People give Jordan Belfort money, the Wolf of Wall Street, the scammiest scammer ever. People pay $10,000 a ticket to go hear him brag about himself. People don't give a shit about anything. Yes, you're going to get your exits. Why? Because the teams have to exit. Ben can't build his machines, his machines without money, which means they got to get that token up. The team at Ocean, those executives, they can't take their exit. The people that were pumping ASI from the fetch side, Humi Yoon and those other guys, they can't get their $100 million exit. None of those dudes can exit. There's $300 million that they have to exit. And the only way they can do that is if they add probably 3 or 4 billion to the market cap. So they're going to pump the inorganic crap out of this thing. They have to. For most of you guys, it doesn't matter anyway. You're so far in the good on this investment. You guys all crushed it. Everybody crushed it. Anybody that's been from the Monday morning live days, anybody there crushed it on Fetch, crushed it on Ocean, crushed it on, crushed it on a bunch of stuff, crushed it on AGIX. So like everybody here got a 10 or 20X, everybody. But if you want that big fat exit, your 2X take 10 or your 4X take 20, whatever, however you decide to do it, you would need them to pump, which they will. Don't worry. Never you mind. They pump, they will. So there's that. Okay. Let's see. I assume if you staked AGIX, you should stop at the end of the next staking period, which is June. Yeah, I would stop staking. I would go now and click the button that says you won't restake the assets. Because otherwise this is going to auto restake. You want to unclick that button. Don't have auto restake checked. Click it. And then once that is clicked, then you can go and you'll have to try 400 times because the site's so crappy, but eventually you'll get through. And you'll have to clear your cookies and restart your computer and try 4 different browsers and all this kind of shit. But at some point you will get through and you'll be able to pull your tokens back to your Web3 wallet that it came from. All right. My whole hypercycle was bought by, oh, that's good. That's funny. Because then you're going to take your hypercycle, your HYPC tokens, you're going to merge those to licenses. You're going to push those licenses somewhere where they're doing compute. You're going to get paid revenue. So indirectly, we should thank those spammy ass teams because they help so many of you. You never got a 10X for Ocean, but did 20X for AGIX and Fetch. Ooh, Charlene, that is some sweet stuff. Yeah, good for you guys. Okay, so let's switch gears. If there's not any more, yeah, they did have some nice artwork. Nicola had some good artwork. So, okay, I'll let you guys decide. We will use some kind of democracy here, some kind of democracy. So today's democracy will be, do we want to attack inference computing first, or do we want to talk about the capital stack makeup and pension funds? The reason I say that I would lean towards the capital stack is because I think you guys are going to hear a lot about this in the future. And many of you, when I say the capital stack, you kind of maybe know what it is. But I thought a good, deep, down in the weeds, capital stack discussion might help a lot of you. So I think that's what we shall do. Capital stack. Ooh, inference computing. Okay, let's see. Let's get some votes. Let's get some votes here, people. Inference. Oh, dang. Donna, I'm on your side, but we're getting beat up here. Run it as per the banner. Ooh, inference computing. No, we gotta let the people speak, man. This is the people. For the people, by the people. Inference. Ooh, okay. Here's what I'll do. I'll make you a deal. Anybody that can give me the complete 7 tiers of the capital stack, not the shorty, the 7 tiers. The 7 tiers of the capital stack. Then we will move on to pension. We will move on to inference computing. But if you can't give me all 7, somebody in the first, say, 5 answers. So now the game theory is like, wait, crap. If I don't know all 7, I better not. Ooh. No, I'm gonna let you guys decide. I'm gonna let your intelligence decide what we're doing next. All right, let me play my little. While you guys are deciding on your answers, let's get this going.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
All right. Here we are. We're in the brain space. Let's see if anybody nailed it. I don't see anybody's answers. I don't see a single answer. Let's see. Senior, preferred, common, mezzanine. No, man. I mean, that's some of them, but that's in no way in order. Man. Let's see. Equity, debt, senior, junior, mezzanine, subordinate, kind of. Convertible, you left out convertible. And then there's 2 kinds of equity. There's preferred equity and there's common equity. Come on, Howard. Man, I counted on you for this. Okay, we're gonna do the equity stack. We're gonna do the stack first, or the capital stack first. The people have spoken. But don't worry, I'm gonna go quick on this. We'll knock this out. We will get through the capital stack. How about this? We will capital stack we will get this done in 5 minutes. Deal? Deal. I'm gonna make it even easier. How about that? Ooh, burn. Okay. Let's talk about this. Let's do a detailed breakdown of the corporate capital stack, including the average yields. So, as you can see here, common equity. Now, this actually weighted. Flip it over in your mind, because this is going from weakest to most valuable. Okay, but it's also going from highest yield to lowest yield. So keep this in mind. But they all have their own kind of risk profiles. So it's not a direct line. Okay. So, but let's keep it like this for the sake of like mental clarity. The only one that can kind of screw people up is mezzanine debt, because mezzanine debt is pretty risky, but it pays big. I mean, it's like more than junk. So anyway, common equity, ownership in the company with voting rights. Okay. The problem with common equity: first in line for dividends, last in line at liquidation. So you have the greatest chance for capital appreciation. Okay. The risk of common equity, I mean, it's pretty high. If the company has trouble, you get dusted. If the company goes into receivership, or if the company gets liquefied, if the company goes into bankruptcy, whatever, you get nothing. At liquidation, common equity holders get nothing, not one flipping dime. So please bear that in mind, Governor. Preferred equity. So you had common equity, now we have preferred equity. Oh, by the way, the average yield in common shares is around 8 to 12% per year. But this varies widely depending on the company's performance, market conditions. That's just over the last, couple of decades. And also, I don't think, see, I would question whether that's the average. I would say the high average is 8%. I would say, I mean, high average, the high watermark. Like if you look at stocks on the aggregate, a few stocks are buoying the entire like S&P and things like that. So I don't think it's quite so clear that 8 to 12 is what you're getting off common stock. But you are getting, in most cases, you're getting a dividend, or in some dividend buyback situation, you're getting some price effects, some accretive price effects. Okay. Preferred equity. This is a higher claim on assets. Well, higher than nothing, the nothing that you get with common equity, but a higher claim on assets and earnings than the common stock, usually with fixed dividends. The risk is pretty high. Okay. With preferred, it's still high risk. It's as high. I mean, it's basically just as high as common stock, although at least you get a slightly better claim. If there's some kind of unwind, you might get a few pennies. So it has fixed dividends. The average yield is around 5 to 7% a year. Preferred stock offers more stable returns compared to common equity due to the fixed dividends, right? Sometimes the equity, they'll adjust the dividends. It's not fixed. So that adjustment can work for you or can work against you. All right. Convertible debt. This is debt that can be converted into common shares. Moderate risk. In my mind, convertible debt sits right down there at or below common shares like equity. But that's just how it works in my mind. The average yield is about 46% a year. This yield is typically lower than traditional debt because of the conversion feature, converting to equity, which adds potential upside. Because you can convert this note. That's why a lot of investments done through convertible notes. Either pay us back the money, or we have the option to convert into the equity. We think the equity is going to do some good things. Great. Okay, mezzanine debt. Now this is moderate to high risk. It's a hybrid of debt and equity, and often comes with warrants or options. All right. The average yield can be 10 to 15% a year, which is astronomically high. Mezzanine debt offers very high yields to compensate for the higher risk. Okay. Then you have subordinated debt, which is juniors. You have junior and senior debt. Subordinate, like the subordinate. This is lower priority debt compared to senior debt, obviously, right? Juniors, seniors. It's moderate level of risk. The average yield is 6 to 8%. So you should still in your mind classify this as kind of junk. It offers higher interest rates than senior debt due to its subordinate position, meaning that if there was some unwind, the junior debt holders get wiped out. Senior debt holders are not supposed to get wiped out. It's supposed to be pretty low risk. So now you have senior debt, and this is high priority debt, often secured by actual collateral. It's kind of nice. So it's collateral. It's not always, but often backed by collateral. So high priority debt, often backed by collateral. Even in the event of an unwind, senior debt holders are not supposed to get wiped. The average yield is about 3 to 5% a year. Senior debt offers lower yields than junior debt because it is considered safer, right? In the event of an unwind. And then senior secured debt. So this is the highest priority debt backed by specific collateral. It is collaterally backed. The risk is low. The average yield is 2 to 4% a year, which again makes no damn sense, because why on earth would you do a deal like that when you could just buy government debt and get, I don't know. Anyway, this debt offers the lowest yield due to its secure and high priority nature, but you may have senior secured debt along with all sorts of other cool things like board seats and trips on the yacht and tickets to the Rangers in the special seating. So I don't know. Anyway, so senior secured debt is the lowest risk. It's the highest priority debt, and it is backed by collateral. Okay, makes sense? Good. Does anybody not get it? Yes, summary of yields. There we go. Does anybody not have this? What are you doing with your ASI? Is that just a general question for the universe? Don't TikTok me. Don't you TikTok me. Okay. I think we've got it. Okay. Why is the capital stack important? Yes. Well, the capital stack is important when you start to talk about pension funds. You say, why would we be talking about pension funds? Well, we're in a weird interest rate environment where the Fed is manipulating part of the yield curve, the short end, and the market is not playing tag. And they're saying, no, we think you're full of shit. And we don't think there is a dearth of growth and inflation expectations as the world is clearly in recession. We think you guys are all full of crap. And we call you on that. And so that's why you're seeing a yield curve that is inverted, where the fake propped end of the front end of the curve, the quicker, shorter maturities, is pegged to some machination of the Fed. And as you go down the yield curve, which is supposed to be slope up and sloping to the right, it's either flat or down, sloping downward. That is an inverted yield curve. And that is when the people that actually deal with money out on the further end of the curve are telling the Fed, you guys are full of crap. And so by propping that up, they create a lot of problems. And for some of them, they create problems for pension funds. So many of you, matter of fact, who here has any exposure to pension funds? You have some money in it. Your parents have some money, something like that. Just a real quick show of hands. Who here has any exposure to pension funds, whether it's your money or someone close to you? Anyway, all right. So it may be important for you guys to understand how pension funds work so that you understand the risks that they're starting to take that you probably don't know, that they haven't told you they're taking. And this can be troubling. So pension funds, the way they basically work is they collect contributions from employees and employers, both. These contributions are then invested in a diversified portfolio that may include stocks, bonds, real estate. It won't be crypto yet, and other assets. The other assets part could include less secure assets. Now, typically, pension funds are not allowed to invest in stuff that is below investment grade, right? But let us continue. Investment grade, basically being triple B. Anything below triple B is not investment grade. And then pristine collateral is triple A. So you have triple A, double A, triple B. Everything below that is junk. Okay. So the goal in all of this for the pension fund is to generate returns that will fund future retirement benefits and obviously line the pockets of the people that run the pension funds. Historic interest rates and investment returns in pension funds. So historically, pension funds have relied on certain interest rates to ensure that they can meet their payout obligations. For instance, interest rate targets. Pension funds often aim for an annual return in the range of 7 to 8%. We always say 7.5%, right? And this target is based on the historical performance and actuarial assumptions about future returns and obligations. Like how much you have to pay out, how long before Joe Sixpack keels over dead and you no longer have to pay. All right. Historic returns. So in the past, achieving these 7 to 8% returns was feasible through a combination of government bonds, which is just, they would buy government debt all the way through the curve. They would buy high quality corporate bonds, meaning AAA. They would buy blue chip stocks. So NVIDIA, Apple, stuff like that. For example, US Treasury bonds in the 80s and 90s often yielded over 6%. So that was a pretty reliable source of income for pension funds. If they need to get to say 7.5 and they can get 6 right here on in the Treasury market, well, they're cracking. They're on the way. The problem is you have either the low interest rate. So a low interest rate environment or an inverted yield curve environment in many ways the same. So in recent years, interest rates have not paid those returns, for example, and you have an inverted yield curve situation mostly because of the Fed's willy-nilly behavior. So in the current environment, like if you look at the past decade, yields on U.S. Treasuries have been as low as 3%. And this creates a significant challenge for the pension funds because they're relying on higher returns in order to meet that 7.5%, right? 7-8%. So what does this do on their investments? Well, so traditional safe investments that provide lower returns, 3 to 4%, 3% is not 7.5%, 4% is not. Matter of fact, 3 plus 4 is not 7.5. So the pension funds start investigating, exploring other investment ideas, other options and opportunities to achieve their 7.5%. And what does that usually mean? It usually means increased risk taking. So to bridge, well, I mean, it always means that. There's no other way, right? This is exactly what they do. They're going to move out on the risk curve. So in the way that there's a yield curve, there's also a risk curve. The further out you go, the higher return, but the bigger risk you may find yourself swimming through. So to bridge the gap between the promised benefits and the returns generated by safer investments, pension funds, they go and they start gambling a little bit. And this can involve corporate bonds. It shouldn't involve junk bonds because most pensions are not allowed to involve, but there's all sorts of weird ways they can participate in junk bond market without directly participating, which is very sketchy. And you want to know if your pension fund is investing in junk. But anyway, corporate bonds, junk bonds, alternative investments. So on the corporate bond side, these are higher yields than government bonds, but come with the increased risk of the company actually imploding. So, like if you were buying corporate bonds in, say, AMC or GameStop, you got wiped. Well, then they went back and raised money from a bunch of YOLO idiots, and maybe you got made whole. But corporate bonds can go south fast. Junk bonds, also known as high yield. High yield's a better name. These are issued by companies with lower credit ratings. They carry a higher risk of default, but they have a higher returns. They're junk. And matter of fact, the risk it's a 50% risk of complete default. That's the risk you're taking. You're taking a 50% risk to get 6.5%, 7% maybe. It's bad. I mean, I see some junk bonds that pay 5%. You're like, why would I get paid less? I can put my money at Coinbase for 5.16. Why would I buy junk bonds that might not even be here? They might not even be, God. They're called junk for a reason, people. Anyway, alternative investments could include private equity, hedge funds, real estate, commercial real estate, commodities, which is all flipping gambling. All of this is gambling. And so while they can offer higher returns, they also come with greater complexity and risk. The alternative investment basket at your pension fund, that's where the badness is. Okay, that's where the badness is, because if they're investing in private equity or hedge funds that are participating in a higher degree of non-investment grade debt, then indirectly they're buying non-investment grade debt. Should probably be illegal, but for whatever reason, it's not. Anyway, so what are the risks of this kind of risk-taking behavior? Well, obviously there's default risk. If you have higher yield investments like junk bonds and crap like that, you have a higher probability of default. And if a significant portion of a pension fund's portfolio defaults, obviously it no longer has the ability to meet all of its obligations. So who gets paid? The dudes in the future or the dudes right now? You're paying in. What you're paying in is going out the back door to Joe Sixpack, old gray-haired Joe Sixpack pulling out his dentures watching CSI Las Vegas. Anyway, so if a big enough portion of the fund's portfolio goes in default, who gets paid exactly? It's not going to be you. Then you have market volatility issues where if you have stocks and these alternative assets, remember, alternative assets mean sketchy ass hedge funds, sketchy ass hedge funds and private equity, sketchy ass private equity that are investing in crap and gambling. So these guys are gambling on gambling. And so that can be highly volatile, and large market swings can result in pretty substantial losses because, these funds, they go away. They just go away. And then you have liquidity risk issues where some of the alternative assets are not easily converted into cash, like a loan on a very esoteric thing. Like you could take a loan against a piece of artwork. You're like, oh man, this is like $100 million piece of artwork. Cool. Here's 20 million bucks. But if you can't find a buyer, it's worth no bucks. So you might have lent $20 million against something you thought was worth $100 million. And it's because there's no buyers, because it's a very tight little market, a niche market. Yes, the on paper value can be high, but the reality is ain't nobody taking it. Here, I'll give you like 40 bucks. Crap. So we lost 20 million, but we got back 40 bucks. It's great. Anyway, so you can have illiquid assets in that portfolio that you just can't get rid of. So, and then you have the two kinds of pension funds. The exit side of it is annuities and lump sum payments. Annuities provide retirees with fixed periodic payments for the rest of their lives. Annuities offer stability, predictability. They don't inflation adjust, unfortunately. So that's at some point you'll be like, damn, my annuity ain't covering what it used to. Yeah, man. It never will. It never can. It can't. It cannot. Oh, that's weird. Anyway, yeah. Okay. Annuities offer stability and predictability, which is good. It's your retirement. So there you go. On the other side of it, no one's ever going to retire. So forget about that. And then there's lump sum payments where retirees may choose to take their entire pension benefit in one single payment. This option can strain the fund's liquidity, especially if many retirees opt for this simultaneously. And by the way, if you're not completely effing financially tarded, you should take a lump sum payment. Get all of your money out and go and redeploy it, because you're going to get destroyed with annuities over time because they don't inflation adjust. So your buying power, your fixed payment in perpetuity is going to buy you less and less and less, because they're going to print more and more and more, and they're going to lend more and more and more into existence. Take your lump sum payment and redeploy it. Do not take an annuity. You can do whatever you want. But if you do take an annuity, you're a fool. There's not very many good arguments for that because, math. Anyway, and I guess, the effective management and regulatory oversight are pretty crucial to mitigating risks associated with pension funds. The problem is you got to trust a lot. Do you trust regulators right now that they're looking out for your best interests? This isn't even like a cynical question. Do you trust that regulators are they lifting the skirt up of all these pension funds? Yeesh. Now, public sector pension funds, they have an even higher burden. But still, they crash, they go under, they go away. So, pension fund risks include diversification risk, where, spreading investments across various asset classes would reduce risk. But if they don't properly diversify, then they don't have that mitigation strategy in play, and they can get beat up when the markets turn wonky. Are they doing regular stress testing, regularly assessing the fund's ability to withstand economic shocks, redemptions, things like that? And how many years can they go if they're not making their 7.5% before it's all over with? And then the regulatory environment, meaning ensuring that, pension funds adhere to guidelines designed to protect the beneficiaries. If you have exposure to a pension fund, you need to get some clarity on exactly how it works. Because otherwise you're going to find yourself maybe holding the bag. You don't want to hold the bag. No one wants to hold the bag. Don't hold the bag. So pension funds are obviously pretty important for financial stability, especially, I don't know if people are as excited about them now, but definitely in the past, that was a big deal. And in low or moderate interest rate environments, kind of like we're in, especially inverted yield environments, the pressure to achieve higher returns leads these pension funds to increased risk-taking behavior. And you guys need to be aware of that. You need to be aware of that exists. So yes, now you are aware. Okay, we will tackle, because it's really a different mind space, we will tackle inferential computing Thursday. So today here, we did this one. We did capital stack and pension funds today. Yay. And then we will tackle inferential computing Thursday. How would that be? I think that would be amazing. Yeah, there's a lot of people counting on these pension funds. It used to be a thing. I always used to be banging the drum on that all the time. I mean, you can math out how many of these funds are probably going to go blow up, and it's a lot. But they blow up it's not like a big blow up. It's like slow. It's a slow blow up. It's a slow train crash. And so you think, well, maybe it's 100, 150 trillion. By the time you by the time you bankroll Social Security, that's crashing. Baby, you guys know that as of 2034 or 2032? Social Security's done, like bankrupted, completely gone, it's not fundable at that point. It can't no longer meet obligations. Well, obviously they're going to bail them. They're going to bail all that out. They have to. That's money they got to kind of create out of thin air. And then these pension funds will slowly slide into states of illiquidity and insolvency. And if that's the case, they got to bail them out. They're not just going to leave them hanging. So once you start bailing people out, you're going to bail everybody out. And the thing is, as they bail people out, the buying power of your dollars goes to dust. And that's the problem. It's the slow erosion of the buying power of your currency units due to bad government behavior. And then that's the Bitcoin. That's the Bitcoin discussion, right? Like if you believe that this bad behavior will perpetuate and continue, then you buy Bitcoin as a hedge against that. And if it's an inverse, if Bitcoin behaves inversely proportionate to bad behavior, if it's inversely proportionate to good, if it's directly proportionate to bad behavior, as bad behavior increases, well then, so too shall the price of Bitcoin. All right. Whew. Yeah, I know, man. It's a lot. Okay. Lotus, you were listening to the car. I put the ASI info on. So for those of you that don't know, the YouTube that just my one that I've been using forever is Nick Black Live on YouTube. And so you can always have that as like a backup. And on that one, I just put the details, the kind of the bullet points of the ASI conversion on there. Yep. All right. And there's posts and stuff going around. Remember, don't do anything. Don't click any links. Don't do any of that kind of crap. People are trying to steal all your shit. Just remember that. Everybody wants to steal all your shit all the time. Everyone wants to steal all your shit all the time. So there we go. Let's all have a great Tuesday. We'll see you tomorrow. And stay in school. Don't do drugs. Don't do anything my poor insolvent drunk strung out on meth grandmother wouldn't do, which is very little. Brandon, I have to assume he's wearing no sleeves because it's probably hot as hell in Idaho or wherever he lives. That was frost warning last week, and now it's hot. I don't know. I don't understand Mother Nature. Seems like Mother Nature is always having that time of the month. That's all I'm saying.
If you're an accredited investor and you want in on angel, seed round, or early round equity and token opportunities in the artificial intelligence and cryptocurrency space, schedule an interview at nickblacknext.com. In life, you can either be really good, really lucky, or just be first. Being first is so much easier. Schedule a digital private client interview today at nickblacknext.com.